Welcome, ladies and gentlemen, for our session called Competing Against Robo-Advisors, Delivering Advice in a New World. We have two panelists today that will offer some experience and insight on the advent of online financial advice platforms. So first is, to my left, your right, is John Prendergast, co-founder of Blueleaf. John, can you give us just a brief overview of what Blueleaf is?
Sure. Blueleaf is a platform that delivers dead simple client reporting and portfolio management, or portfolio monitoring rather, for advisors and their clients. For the client side, you can kind of think of it like mint.com for advisors. And in the context of this conversation, we're an arms dealer. We deliver the same kinds of capabilities that some of these online advisory firms have to every independent advisor.
Thank you, John. And to John's left, your right, is Alex Murguia. Alex is managing principal of McLean Asset Management, and he's also co-founder of InStream. Did I get the co-founder part correct?
Depends on who you ask.
All right. He is president, CEO, and founder of InStream. So Alex, give us an overview of what InStream is.
Sure. I will do that in the context of how the genesis came out of McLean. Essentially, I run a wealth management firm, McLean Asset Management, and roughly, probably this year, we were in the $520 million range, and I'm saying that from the standpoint that, you know, we kind of get a good sense of delivering advice and how can we do that in a scalable manner. And about 2 years ago, the realization was that, you know, there's some things that we can't scale, and in light of the consumerization, if you will, of financial planning softwares that are out there, you know, how do we want to position ourselves for the future? And that led to the genesis of InStream. It was one of those that I wanted to take a swing and do it. And InStream what I feel represents the next generation of financial planning tools, a wealth management platform, if you will, for advisors that tackles some of the challenges that I feel that advisors are going to face in the future.
Thank you, Alex. So I'm going to launch the first volley of questions, and I'm going to direct it at you, John. And I want to ask what you are seeing that's changing in this environment for the delivery of advice now that the internet has matured, where there are a number of apps that we can access on our desktops and laptops, but also our mobile devices. These apps have come along and really lowered the barriers to access for online advice. So what is really changing in this area that financial advisors need to know about?
Yeah, so in a word, and I'd expect that advisors know this already, but in a word, it's expectations, client expectations. And that's driven by some of the technical changes that we're seeing in the marketplace. Alex used a great word, consumerization. Heard it on a panel earlier today. It's a really big trend, and it's really this idea that that simplicity, ease of use, can make an experience completely different, can really transform an experience. And so you're seeing this across the technology landscape, not just in financial services. It impacts financial services in that the complex reports that clients are used to seeing are no longer satisfactory. They want more simplicity. They want this to be obvious. And I think for what we're seeing is more and more clients want to be a co-pilot in the relationship, not just hand over keys and be chauffeured.
So Alex, what are you seeing as you started making your investments in the InStream platform? How did your knowledge and awareness of consumer expectations in this modern mobile age, how did that factor into some of the deliverables that InStream and some of your competition too are able to provide not only to advisors but ultimately to end clients?
I think to answer that question, I'll answer it in the reverse. It wasn't necessarily that I was empathizing with the consumers that were out there right now. It was more, how can I run my business in a scalable manner, period. And deliver the consistency of client service across advice that allows me to do so. And that's what led me to, you know, crack open the hood of the car and begin to rebuild it from scratch to some extent. And you know, with what's out there, you take you had mentioned Mint, and there's others, Bundle or whatnot. And it was really, how can we begin to compete? Because it's not that I'm scared at all of these systems right now, but you take a page out of, I think it was Gandhi, the sort of quote, first they ignore you, then they laugh at you, then they compete with you, and then they win, if you will. Or we win, better said. But, you know, as an advisor, you know, I look at man, I'm like, yeah, so what? You know, frankly, right now. But there's going to be more and more of that, not less and less of that. And so, to some extent, you look at how you're running your business, and at the end of the day, you can scale quite a lot. And everything is meant for workflows, you know, back office workflows and things like that. But there's not really something in place right now. And again, that's what led me to create this, that really takes the planning process and is designed to proactively guide a client through a financial life cycle of decisions. And I wanted to do that without disintermediating the advisor. At the end of the day, the products that, you know, have been mentioned disintermediate the advisor, and I don't, you know, I agree with John, but I don't agree with John in the sense that clients want to be more involved. There's plenty of clients that are delegators as well. In fact, I would say a majority of our clients on the client are delegators. I mean, they've chosen to pay us a fee to manage their assets, and they're like, you take care of that. They know how to do it. They're smart enough. They just, you know, they can't be bothered with it because they'd rather play Plants vs. Zombies or, you know, other things. You know, so to that extent,
he has a younger client.
Yeah, exactly. So to that extent, I really did it from a business management process standpoint. That could help me scale my business and led me to do the industry.
All right, so you mentioned the disintermediation of financial advice. Who are these platforms that are coming online? What are they called? Who should advisors be paying attention to that are disrupting this service model? Some of them are coming along with free or super low cost platforms. So who are the parties that are involved? What are the names that advisors need to be aware of?
You want me to begin and you end it up?
Go for it.
Actually, why don't you begin?
I'll begin. So look, this is not new for what it's worth. I think since there's been software and since there's been the internet, there have been attempts to automate, you know, financial planning, attempts to automate financial management. So that part's not new. There is a new wave of this activity, newly financed companies that are interesting and useful and potentially instructive to watch. So a couple that I think of are Wealthfront, which is formerly Kaching, and Wealthfront, yes, as an affront to wealth, and Personal Capital. Wealthfront started out as a Facebook game called Kaching, where you would follow people who are trading and try and out-trade them. It was very sort of trader-oriented. Eventually what they evolved into was a channel, basically connecting investors to small and medium-sized asset managers that otherwise wouldn't go retail, and allowing retail access to folks with much higher minimums than they would typically have access to. That was their original model. And they've evolved to start to think of themselves more as an online financial advisor. So that's Wealthfront. And they are evolving to compete with people like the second name, Personal Capital. Personal Capital is a recently launched, though been sort of in stealth mode, which for what it's worth, I think is for airplanes and not companies. But they've been in stealth mode for a couple of years now, founded by one of the former founders of Intuit, Bill Cook. And they've spent $20 or $25 million building a platform to deliver online advice with the idea as a user-friendly front end, and to sell advisory services, direct retail, but with very limited human advisory, you know, input. The interesting thing about these things is how they haven't really been disrupted yet. They haven't cracked the code, and the code isn't how to automate financial advice. It isn't how to do a calculation, you know, off of Monte Carlo analysis and allow a consumer to do that. Sure, that's easy. The hard part is actually the relationships, and the interesting thing to watch is, do they crack the code of customer acquisition? That's really the driver here that makes them unique and different. We'll talk, you know, happy to talk more about this particular equation later, but really the challenge of all advisory businesses in terms of scalability isn't just on the operational side. It's scalable customer acquisition model. And that's where these guys have some hope of breaking through, finding an inexpensive way to acquire customers. The philosophy can be to acquire data ahead of acquiring assets, and that's something relatively unique that we've seen only recently. And the third is more obvious and less about financial planning, but Mint. Everybody knows Mint. They don't offer services, they don't purport to, they offer a bunch of calculators. This is interesting because Mint did in fact crack the code on cost-effective customer acquisition, somewhere in the single digits range per client that they acquired on the platform. Now, unfortunately, their monetization model didn't do much better than that. So it's really finding a model that finds low-cost customer acquisition and marries it with the kind of monetization that you expect from an advisory service. So those are the three guys that I pay attention to.
And Alex, there's a few more names out there that I'm sure you are aware of. Who else are you thinking about that may qualify in this robo-advisor?
Well, another one that's been, and again, these are well-funded companies. These aren't necessarily bootstrap companies, somebody running them out of the garage. I mean, the investors here want a significant impact in terms to make their IRRs sing to a large extent. And one that strikes me, another one that's getting a lot of press is LearnVest. You know, and that LearnVest.
LearnVest.
Yeah, very different model, but really interesting.
But it's an online platform, if you will. Now, I'd like to switch the tables. Again, answer it from the other way around, like from an advisor's perspective, like, okay, there's these, I wrote them down in the paper. I'm going to put them on my Yahoo alerts, whatever. But really, the more important question that I would be wondering if I'm sitting across the side from, sitting in your place is, well, what as a firm should I be doing? What should I be thinking about doing? Or how does this play out?
Yeah, you're getting ahead of me, Alex.
Okay, then
but that's totally fine.
Okay.
So you got LearnVest. Are there any others that are on your radar? Hello Wallet, Betterment.
Okay, fair enough.
Are they sort of in this category, or are they less of a concern?
They're less of a concern to me, frankly, because at the end of the day, and this is my own personal proclivity here, I guess, is from a budgeting standpoint, as an advisor, at least through McLean Asset Management, budgeting is not something that I get involved in, nor do I want to get involved in. And frankly, I think that the audience that gravitates towards budgeting are the folks that most likely wouldn't be my clients to begin with. And so to the degree that they can serve as a stepping stone to an advisor, great. But there's a double-edged sword, because then they get used to an electronic interface to get advice. And so, it could be tricky to some extent, but it's one of those that I'm more looking at the investment platforms at this point. And if you're really sure Hello Wallet gets all the news and, putting in a behavior component to it, in theory those are great, but in applicability, I don't think giving me an alert when I walk through a bar telling me that, hey, you can't spend any more money on beer is very helpful. From that standpoint, I don't know. I have to see it. I don't know what the usability stats, the utilization rates are for budgeting tools. So no, I'm not particularly worried, but it's something to keep in mind, because that could transition into just getting investment advice at the same time.
John, anything to add?
I'd put them in categories. I think about the various approaches to market. So we've talked about a few. Personal capital and Wealthfront seek to be direct competitors of the people in this room. They look to disintermediate, to use Alex's word, independent financial advisors and even large firms. Betterment is an interesting example. They're really an asset management firm. They seek to sort of automate a kind of a customized mutual fund, if you will. It's the idea that you set an asset allocation, there's a black box, and they charge you 100 basis points to manage that pot of money. Their intention is to disrupt the mutual fund industry, not the advisory business. And then there's the LearnVest, which I think is a great example, and a completely different one. That's a publishing business. So LearnVest is about financial content targeted toward young professional women, and is a model that's very similar to another business which most of you probably have never heard of, called Daily Candy. And it's designed to publish content and have very high advertising rates, and have because they've got such a targeted, responsive audience. They leverage email, and it's a Alex is a powerhouse, great entrepreneur, very young, 26. But it's at least today less disruptive to advisors.
I see that, but they're in that, in a broad brush sense, though, when you can get a financial plan for $50 or whatever. I mean, I don't know if that's the actual price, but when you can sort of get deliverables that an advisor's giving.
Yeah, $349, I believe, is the retail price.
$3.49.
$349, but you're still in that realm of you're well below $1,000. And I think there was a recent discount that was running a week ago that it was 50% off that price. So now you're sub 200 for advice delivery from a certified financial planner certificate.
Yeah, I mean, and there's nothing wrong with that in theory, but I do think. Well, I don't want to get ahead of yourself. I don't know what your line of questioning is going forward, so let me hold back.
So we've put these names out there on the table. Now that our advisor audience has written them down, what is there to be learned? Should advisors go and sign up for LearnBest and get a plan done for $350? Should they sign up and put their credentials into investment accounts into personal capital? Is there something to be gained by going through that experience?
I think there's a hierarchy of things that you need to consider, and before you consider that route, although it's good to know, but I think you still got plenty of time before you need to do that. I think you have to take a look at your business, and then realize what is your value proposition. And I said it the other day, and I guess maybe it's becoming my mantra a little bit, but what is your value proposition? If it's, I know. Let me say it another way. How many of you here? How many of you are active investors? Believe in an active investment approach.
What precisely do you mean by that?
Stock picking, tactical.
Oh, in other words, the time of holding the portfolio holding time is not relevant. Merely, are we trying to pick individual stocks versus
indexing.
Are you trying to outperform the market?
Yeah, okay.
Versus,
Then the answer is yes. Okay.
All right. How many of you folks are passive investors? Okay. Now, to a certain extent, it's a very different approach, and bear with me here from a follow-up question standpoint, I would venture to say the value proposition, the underlying value proposition for your clients is the same, which is, I'm going to help you achieve your objectives. I'm going to, at the end of the day, that's ultimately what we're trying to do. Now, if you strip out, you peel away the onion, and I ask every advisor here, in their hearts of hearts, where are you relative to achieving all of your clients' objectives right now? Can you answer that question to me right now? We'd have a difficult time coming up with that, if at all. We'd have to redo plans. We'd have to. Linda's here, and please, Linda, chime in. She's the gray matter behind Naviplan, so feel free, because this is, somewhat relevant. There's that. Are you coming through on your value proposition? Because to your point, Bill, sure, you can do this electronically, and if you look at other industries, let's say the CPA industry, when if you're the advisor doing 1040s and nothing else, then you got it handed to you when TurboTax came out. To a large extent, and you really had to redefine your business. I'm going to get into international taxes or whatever, which then led more people into that realm, and did have ultimate pricing pressure on the CPA industry. But from your standpoint, should you get a client to get on LearnBest and check it out? No, I think you as an advisor needs to think about what is your true value proposition to your client, and can you come through on that on a scalable basis. As opposed to worrying about precision with regards to something that may be uncertain at best. Why don't we worry about, can we proactively manage a client life cycle? Because that ultimately is why a client pays you either an hourly or retainer or an AUM base. And if you're really not coming through with that, if you're handling calls as opposed to being proactive and out there and getting in front of the client, well then, you know what, Bill? Forget about even getting a client online. They're going to do it themselves eventually. So I think from a hierarchy of needs standpoint, you need to ask yourself, am I coming through on my value proposition, and can I quantify it? Because if you can't, there is no value proposition at the end of the day. And I say this from the standpoint that I suffer at McLean Asset Management from those same mills. I'm not trying to preach, it's just, that's my everyday battle.
John, any follow-up?
Yeah, a couple of things. One, it dawns on me that we should probably define what we mean when we say scalable. It's one of those words, I don't know, what have we heard a lot about? Integration. Someone shoot me if I hear integration again this week.
Integration. There are going to be shots at the bar
There will be
tonight
shots at the bar.
for integration counts.
So scalability in a business model context, from my perspective, is the following thing. It means that your cost of acquiring customers is lower than the lifetime value of those customers. Further, that your ability to scale your operations to service the customers is something that you have full control over and there are no limits on. On the acquisition side, you can use metrics like your cost of customer acquisition has a payback of faster than 2 years, preferably faster than 1 year. And again, there are no limits to your ability to hit the gas pedal and grow as fast as you'd like, assuming you have the money to invest to do so. It's a high bar for scalability. I'd argue under that definition, there are maybe no financial advisory businesses that are actually scalable. Maybe a very small number. It's a very high bar, but that is where the robo-advisors that we're talking about are actually trying to innovate. They're trying to innovate around the scalable business model, this notion that I can grow as fast as I choose to. And we are all governed, every business, my business, Alex's businesses, all of your businesses are governed by this equation of cost of acquisition has to be less than lifetime value, and it has to be significantly less. So when I think about the robo-advisor, I think about business model innovation, and I think about what have they got to teach us as an industry, what have they learned, what have they failed to do, and how do we use that. The other thing I'd say, I think Alex's comments about value proposition is important, and I'll ask this rhetorically, but my guess is if I asked you all how much of your value, what percentage of your value that you deliver to your clients is tied up in tangible deliverables, this plan, this document. I saw it in the back, this much. There's even a squeaky sound, this much. And this is where robo-advisors go wrong. The view is, let me just deliver the plan, let me give you the calculation widget, let me do this, and that's it, we're done, right? I got news for you. Humans have real concerns around their finance and their health. It is two areas where human interaction is not likely to disappear anytime soon unless you know something about the changes in human nature that I don't know. People get concerned about money, they need help. Now, we don't all want to feel like we're the ship's counselor, we want to feel like we're the science officer, but in many ways we are in fact ship's counselors. That's a good thing. This is something that these highly automated systems can't in fact automate. But what they can do is scale that interaction. They can take it and make it such that rather than this mythical 100 or 125 client limit that we think about, why don't we think more about how do we scale the business and make it 1,000 client limit? And let's be heretical and say, what if we could service 1,000 clients per advisor better than we do the 125 today? That's the kind of questions I think these kinds of businesses force us as a business to ask, and they're great. It forces innovation.
I want to turn it over to the audience to make sure that you have the opportunity to ask your questions and interject some of your comments. So if any of you have something to say or have questions, feel free to start. Yes, sir.
My office is employed this year. There's a guy employed that meets with people and charges 25 bits. And he doesn't do the planning, but he does the investment. And there's a face-to-face to gather the assets. They do the investment, they do the reporting, but there's no pretense of any kind of planning. What do you think of that business model?
Okay, so the business model was charging 25 basis points strictly for investment services. What do you think about just a pure investment delivery of service?
Let me start with a philosophical answer first. My opinion here does not matter. I'm dead serious about that. What matters is the market's response. So I'll respond with a question. How many clients has this person been able to attract? How happy are they? What's their client churn? At the end of the day, the market's the arbiter of what's valuable and not. And so if this person has delivered this and is being wildly successful because people are beating down that person's door for that service, then I think it's a great idea. There's a market for it.
Is it? I guess my question is, have you seen, this guy is very successful, he's got 500 million assets, good model, but have you, for him, it's working well, but have you seen that model on a broader scale than just one person that I'm aware of?
I haven't, because when you said that, what I heard was, okay, is there enough money flowing through that system to support an infrastructure that goes beyond one single office, right? Multi-offices, multiple people, back office support, et cetera. 25 basis points is very hard to make that work if there's any human component involved today. And that's likely to be true for a while. So my guess is there are limits to scale there based on his ability to support multiple offices, multiple advisors doing this. But he may have figured something out, or she may, I don't know whether it's a he or she, may have figured something out.
I would say the only thing that, you know, to John's point, with personal opinion here, at the end of the day, my firm, we're a passive shop. And so, you know, if he's doing it on an active management value, this is what I can add, then fine. But if he was doing this from a passively managed standpoint, then I think those are the folks that essentially do a set it and forget it type of portfolio are gonna run into trouble, you know, through folks like this. I mean, I'm not coming from John's angle of the pure, you know, how many offices do you have and what's the infrastructure, although that's 100% valid. That's ultimately the end game there. But I'm just thinking, you know, intuitively, those are the things that, in my estimation, are going to come under the most pressure over time when you run up against an online platform that's essentially doing the same thing. That would be my take on it, unless you're providing value beyond that. And there is one component that John and I were talking about yesterday that gets lost in the whole mix and that you don't really see from an internet interface, and that's one of the value. You know, you think about value. Value can come from acts of commission, acts of omission, to a certain extent. And as advisors, I do think that we get paid to some extent to provide an insurance premium, to keep clients from making mistakes, and that's hard to show, you know, frankly. But that's there, and that's, to your point, why there will always need to be some sort of human need. And the other point is, as advisors, clients tell us many times their deepest secrets. And it's, you know, to some extent, it's just a hassle to go somewhere else and expose a new advisor with those same things. And so there is some natural stickiness. I mean, it's just part of the course to be an advisor. We have significant advantages of it. But if you're just doing a set it and forget it model portfolio for 25 bips, I would venture to say an online interface can do it at a significantly better price for that end client. And eventually, maybe not right now, maybe not tomorrow, but eventually, that's a target. And it's not a lot of money. You know, 25 bips at 500 million. It's hard to scale that business in from John's point of view.
So John, you mentioned market forces and the market as the ultimate decider. Thinking about that perspective.
I think the ultimate decider was George Bush, just to be clear.
Thank you.
Senior?
What's happening to margins for these advisory firms? Are margins being threatened by these low-cost platforms? Do advisors need to be very conscious and apply more business metrics to their margin monitoring and all of that? How are these platforms, if they are at all, putting pressure on that?
You know, honestly, I think the audience is better equipped to answer that and how they're feeling in their own business with respect to that. From a market perspective, I think what I've seen in the data is that in the middle, advisors who are charging, let's say, 100 basis points are feeling a little bit of pressure, like they always have, a little bit. But the pressure is really being applied at to the salespeople, the folks who are selling you something that's 250 basis points, that's some horrifying aberration of a product that really is actually harming the client. I think there's a lot of pressure there because of the transparency that's come around and the availability of information and pricing, et cetera. That's where I see more of the businesses having trouble. But in the middle, it seems like because advisors are providing that sticky service of being a counselor, we haven't, on Blue Leaf, we haven't noticed any deterioration in margins of the advisors on our platform.
I'd like to answer that.
Yeah, and Alex, you talked about your client characteristics being primarily delegators, and I'm sure that McLean falls into that 100 basis points plus or minus revenue.
Exactly. I think our blended rate, off the top of my head, is about 92 bips when you take everyone into consideration. But ultimately, we don't see pressure from from these people right now. You're not going to, like how I began it. It's just not there right now. But it's one of those things that, look, disruptive innovation begins by us just ignoring it. That's the nature of the disruptive force. So it's not something that anyone right now is going to leave here wondering, you know, lions and tigers and bears. Oh my, no, not at all. It's just one of those things just to keep in your radar. And I would view it from the standpoint of how I can improve my firm. And, I mean, from the margin standpoint, if you look at the Moss Adams stuff or investment units now, there is margin compression, but the margin compression is not because of the online competitors. The margin compression is because we're ultimately small business folks, and as we grow and grow and grow, all of a sudden we're a CEO of a company. And now we got to really institutionalize the firm and so forth, and that requires investments and things along those lines. So that's where you're seeing margin compression, not in this matter. But it's very easy within that margin compression theme to realize, let me cut back on the wealth management services, and it's very easy to then just do a model portfolio and fall into that trap. Because everyone here, well, let me not generalize like that, client asset management or so forth, you have a subset of clients that were legacy clients and that are sort of locked in right now, and that, you know, there's a model portfolio feature to the servicing that you're giving them, and to some extent those are the ones that, you know, are ripe for attrition, if you will, and go on to something like this at a certain point. Right now our attrition is, if I were to venture to guess, it's less than 1%. It's usually if someone passes away or something like that. So does that answer that question from just a business model perspective? It's not necessarily from an in-stream perspective.